Picture this. You're glued to your trading view screen in the middle of the New York session. The one setup you've been stalking all week is finally here. Clean up trend on the higher time frame, pull back into support. Liquidity swept below yesterday's low, volume building right where you said you'd take the trade. You promised yourself this morning. If price tags that zone, I'm in. 1R risk, stop loss below the wick. No moving it, no adding. The candlesticks tap your level. A thought slips in. What if this is the time it just nukes straight through? What if I get stopped out again in front of everyone in the Discord? Your heart rate jumps, you bounce between time frames, redraw the same support line you've drawn 3 times already, as if the market will respect it more if the line is straighter. 10 seconds later, the candle launches without you. You watch the unrealized profit that should have been yours run in a straight line. Now the dopamine flips direction. Okay, I missed the clean entry, but if I hit buy now, I can still catch the move. You slam a market order with double size, no clear stop loss, no plan. That's self-sabotage disguised as trading. Here's the dark side no one wants to admit out loud. Most traders aren't just losing because markets are hard. Most traders lose money because they are at war with themselves while trying to read a chart. This is not financial advice. This is a mirror. In theory, trading is simple. Define a setup, define your risk, place the trade, accept the outcome. In practice, your brain is trying to survive, not follow your trading plan. Green P&L spikes dopamine, the same reward chemical that fires in gambling and social media addictions. Red P&L spikes cortisol, the stress hormone that screams danger. A sudden wick against your position hits you with adrenaline, like a car almost swerving into your lane. After a series of losses, your mood crashes and you start trading not to execute your edge, but to fix how you feel. Then the social layer kicks in. You see Twitter flexing 10R wins, crypto Discord screaming apes together strong, Telegram channels calling 5 scalps an hour. Your brain absorbs that as the standard. If you're flat, patient, waiting for your A setup, a part of you feels like you're failing. So you open a position just to feel like a real trader. And then comes the trading paradox. The cleanest setup often feels the worst to enter. The best trades usually show you red first. The tighter you drag your stop loss to protect yourself, the more often you get wicked out at the exact low before the real move starts. The more you stare at multiple screens and indicators, the more scared and confused you get. More effort, worse performance. Self-sabotage in trading isn't random. It's your survival brain trying to protect your identity in an environment where uncertainty is permanent and pain is possible on every tick. Let's zoom into a few of the most expensive patterns. First, entry hesitation paralysis. You do the work, mark the level, journal your plan. You watch price tap your zone, and you freeze. Deep down, what's at risk isn't the money. It's your belief that you're getting better. As long as you don't click, your trading system is perfect in your head. The second you enter, reality can punch a hole in that image. So you wait for more confirmation. By the time you feel safe, the edge is gone. Second, stop-loss removal syndrome. You enter with a plan. 1R risk, stop below structure. Price moves against you, tick by tick, and your chest tightens. Instead of accepting the small loss you agreed to, you drag the stop lower. Then you delete it. Now you're not trading a setup. You're trading your refusal to admit you are wrong. This is exactly the kind of perceptual distortion Mark Douglas warned about. When reality doesn't match our expectations, we block out information to avoid emotional pain, until the market forces awareness with a much bigger loss. Douglas, Mark, the disciplined. Third, revenge trading loops. You get stopped out. Your brain flags that as a threat. A part of you doesn't care about the next high-probability setup. It cares about repairing your self-image as a winner right now. So you double size, force a new position, or flip direction 3 times in 10 minutes. The chart becomes background decoration for a nervous system stuck in fight or flight. That's why you can end the day wondering, why did I even take half of these trades? Notice something. None of these errors have anything to do with whether your system has an edge. They're all about how your beliefs, expectations, and emotions distort what you see on the screen. Now meet Marcus. Marcus doesn't blow up because he's stupid. Marcus blows up because he's smart, confident, and hurt. He's the reformed gambler archetype in real time. 3 years ago, Marcus discovered crypto futures. Binance, Bybit, one-click 50x leverage, P&L flashing in neon. At first, he was a pure degenerate. No stop loss, all in positions, guessing tops and bottoms on the 1-minute chart. He turned a small account into something meaningful in a few lucky weeks, then watched it evaporate in 2 days when Bitcoin trended against him while he slept. Account 1, gone. Account 2, gone. Account 3, nuked during an overnight liquidation cascade. Each time he blamed the exchange, market makers, they hunted my stop. Everything but his own behaviour. When the third account died, something cracked. His self-image as the guy who always figures it out didn't survive. That's when he found trading psychology. He learned that the market is an unstructured environment that doesn't care about him, and that most of his childhood conditioning, avoiding pain, seeking certainty, needing to be right, actually makes him worse at trading. Douglas, Mark, the disciplined. He realised there's a gap between who he is in his best moments and who he becomes under pressure, and that closing that gap is the real work. Trading is psychology to do mirror from best. So Marcus did something most gamblers never do. He stopped trading completely. For 3 months, he went flat. No positions, no dopamine from flashing P&L. He built a mechanical system on TradingView for a single futures pair using simple rules. Trade with the higher time frame trend. Wait for a pullback into a predefined zone. Only enter when volume confirms. Risk 1% per position. Never move the stop loss further away. He back-tested, forward-tested on demo, then sized tiny in live markets. On paper, his edge was real. Over hundreds of trades, the system made money with reasonable drawdowns. But when he came back to full-time day trading, the dark side reappeared. Here's what an average bad day looked like. Marcus wakes up early, does a quick workout, then sits at his 3-monitor setup. 1 screen for the higher time frame structure, 1 for intraday execution, 1 for level 2 and order flow. His rules are on an index card. 1 setup, 1 risk per trade, no moving stops, no revenge trades. First trade of the day, textbook. Trend up on the 4-hour, pull back into his marked demand zone on the 15-minute, buyers stepping in. Marcus enters long with 1% risk, stop loss below the prior wick, take profit at 2R. Price wobbles, almost tags his stop, then reverses and hits his target. The system works, he feels like a professional. Second trade, another valid setup. This time price tags his level and slices straight through it. His stop loss gets hit within minutes. It's a normal outcome in a probabilistic game, but his body doesn't care about probabilities. Cortisol spikes. You just gave back half the morning gains. Now Marcus is activated. Third trade. There is no valid setup, but he's still staring at the chart, needing to fix the loss. He notices a tiny bullish candle off a random intraday level and talks himself into it. It's front-running my zone. Smart money is stepping in early. He enters with larger size to make back the loss. Price chops sideways, slowly bleeding against him. Instead of taking the planned stop, he moves it further, then deletes it to give the trade room. By lunchtime, he's in a full-size, unplanned position with no clear invalidation. Every tick against him feels like an attack on his identity as a disciplined trader. Eventually, the market does what it always does to traders who refuse to take small losses. It finds their pain threshold. A sudden spike flushes his position deep into red. He panic closes near the low of the move, exactly where his original mechanical stop loss would have been hit hours ago, only now the loss is triple. In one morning, Marcus has perfectly demonstrated what Steenbarger calls trading to avoid pain instead of trading to seek opportunity, focusing on P&L, ego, boredom, and self-esteem, instead of on the auction process itself. 2 Brett Steenbarger. Psychology. So how do you stop turning normal market randomness into self-inflicted damage? First, accept that self-sabotage is rarely about willpower. It's about unexamined beliefs running your trading from the shadows. If, deep down, you believe, I must not lose or I'm only worthy when I'm right, then every small loss becomes a threat to your identity. Your brain will then distort your perception, dragging stops, forcing entries, cutting winners, to protect the belief, even while it destroys your account. The solution is not more discipline quotes on the wall, it's a mental house cleaning of the concepts you bring to the screen. Douglas, Mark the Disciplined. Second, remember that most traders lose money. That's not an insult, it's a starting statistic. The majority trade without a genuine edge, without processes, and without any structured review. They think more screen time will magically turn into skill. But what makes traders great is not a single best practice, but best processes, routines for adapting, reviewing, and improving how you think, not just what you trade. Trading Otgar psychology. From best risk management isn't there to limit your upside, it's survival. Without it, your psychology never has time to mature because you keep blowing yourself up before you can learn. Third, accept the core paradox of probabilistic trading. You can do everything right and still lose on the next trade. Past patterns don't guarantee future results. The job is not to make this trade work. The job is to execute your edge over a long series of trades without emotional contamination. Professional traders in the market wizard stories didn't become consistent because they felt confident. They became confident because they survived long enough, with small enough risk per position, to see their edge play out through brutal streaks of randomness. Fourth, bring neuroscience onto your side. If you know that green P&L spikes dopamine and red P&L spikes cortisol, you can design your environment to reduce those swings. Hide your running P&L during the session. Limit how often you check your equity curve. Trade smaller than your pain threshold, so your nervous system stays in a learning state instead of a panic state. Here's how Marcus rewired his trading. He built a simple pre-market checklist that started with psychology. Not charts, sleep, stress level, outside problems. If he was above a certain stress number, he automatically cut his size or didn't trade at all. He changed his goals from P&L targets to process targets. Only take trades that match my written setup. Respect every predefined stop loss. Journal every emotional spike and what triggered it. If he hit those, he considered it a winning day. He also rehearsed his worst triggers. Before the session, he imagined the perfect setup that immediately moves against him, the winning trade that retraces, the breakout that leaves him behind. In each mental replay, he practiced breathing slowly, sticking to his rules, and accepting the loss or miss without chasing. Then he hard-coded friction into his platform, confirmations before increasing size after a loss, no market order hotkeys, and a timer that made him step away from the screen after any loss, larger than 1R. Finally, he built a brutally honest review ritual. At the end of each week, he marked his trades with 2 colours, green for according to plan, red for emotion-driven. He didn't just count R's, he counted acts of sabotage. His goal was simple: reduce the red events. Over months, the red marks shrank. His drawdowns became shallower. His average R multiple per valid trade increased because he was no longer cutting winners at the first sign of discomfort. So picture Marcus again at his desk. A setup forms. Cursor over the buy button. Heart rate climbs, but he notices it. He breathes out slowly and says out loud, 1 trade in a series, 1R risk. Click. He's in. Price immediately moves against him. Old Marcus would have tightened the stop, or bailed at the first sign of red. New Marcus watches the order flow and lets the planned stop loss stand. This time, it actually gets tagged. He's down 1R. The temptation to make it back right now is loud, but his process is louder. He logs the trade, logs the emotion spike, steps away. No instant re-entry. 2 hours later, another valid setup appears. If he were trading to fix his feelings, he'd still be tangled in the previous loss. Instead, he takes it with the same small, predefined risk. It runs cleanly to 3R. Net result: up 2R on the day, but more importantly, 0 revenge trades, 0 moved stops, 0 random scalps born from boredom. That's what it looks like when the dark side of trading psychology doesn't disappear, but gets managed. The fear, greed, and ego are still there, but they're no longer driving the car. Most traders will never get here because they refuse to believe the problem is internal. They'll keep buying new indicators, new Discord rooms, new secret order flow scripts. anything to avoid confronting the simple, brutal truth. The biggest enemy of your trading account is not the market, not the whales, not the algos. It's the part of you that would rather protect your ego today than protect your equity curve for the next 10 years.